and welcome. The HDFC Balanced Advantage Fund has crossed a major milestone, 1 lakh crore rupees in AUM, making it one of India's largest fund in the Balanced Advantage Fund category. At the helm is Gopal Agrawal, Senior Fund Manager Equity at HDFC Mutual Fund. He also manages key equity mandates like the Large and Midcap and Multicap funds. So today we talk to Gopal about navigating a fund of this scale, his unique approach to portfolio construction, and what sets HDFC's BAF apart in a crowded market. Welcome, Gopal.
Thank you.
Now, to begin this conversation, the Indian equity market has rallied sharply over the past year. So, are we entering expensive territory now, and what are the risks that are on your radar?
So the current market has rallied in line with the policy decisions taken by the RBI to cut the repo rate and inject liquidity and also reduce the CRR rate going forward, which has reduced the bond yield from 7.35 to 6.3%. So in a way, what has happened, the Indian equity market has been reset at a higher level as the discounting rate has come down. Right. So the going ahead, my sense is that after this rally, Indian equity market is trading at closer to 14% premium to long-term average, which is slightly on a higher side, but not the at the option level what we saw in September 2024. So certainly we are entering into a slight expensive zone, but if the earnings are strong, then I would say this is expensive, but not at a very expensive level or option level.
Sir, despite the broad surge in the markets, are there still segments which are available as a value segment in the today's market?
So after this rally, still I feel the large banks, insurance company are looking relatively attractive. And on a medium-term perspective, I feel there is still value left in pharma and auto sector going forward.
Now, moving on to your investment style and philosophy. So, do you approach stock picking from a bottom up perspective or start with a macro view? If you can share that with us.
So generally, I follow bottom-up approach for stock picking, but generally also I have a certain eye on what's happening globally, right? Because that also gives us some direction that how the things are going to perform in the times to come. I'm really a votary of free cash flow to yield method actually, because I believe that cash is king. The company which generated higher free cash flow and commensurate higher ROE should command decent valuation in the market. So the free cash flow yield method is where I follow significantly more. Then in some cases I also look at replacement cost and these are and the relative valuation. So these are the three parameters I use widely while picking up the stock and constructing the portfolio.
So, but given the history, what we have seen is, the stocks which are having a higher free cash flow obviously have a high premium, high valuation. So, how do you dabble between this high valuation and growth while choosing the stock?
Chirag, what has happened over a period of time, the nominal GDP growth rate of India has moderated from 14% to closer to 10%. So in this scenario, what happened if any company is giving us consistent double-digit top line and bottom line growth, can continue to command a significant premium as compared to the historical valuation and to their respective peer. So when a company trades at higher multiple means I believe they should minimum have this kind of growth, double digit growth higher than nominal GDP growth rate, and also ROE in double digit closer to mid teens to high teens actually.
Now, sir, coming to one of the funds, HDFC Large and Midcap, which has done very well. So it's one of the most diversified funds in the category with over 200 stocks. So just wanted to understand two things on it. Is this core to your style across mandates of holding such large number of stocks? And secondly, how do you manage and track such a large universe of stock?
Generally, my approach towards the portfolio construction is to give the absolute positive return to the investor. Though as a mutual fund manager, I'm always benchmarked to an index actually. And many of the businesses generally go through the economic cycle, right? And what I generally believe, when an investor has come to the mutual fund, I should try to protect their downside and give them absolute return consistently and over time. That is my endeavor. So that is why I try to buy the stock wherever I feel there is an absolute value in the stock, give and it should sustain all the economic cycle. So that is why I take exposure to the extent where I feel this stock should sustain at this valuation. Okay, so that is why I consistently look at the various opportunity available in the market. Second point is that on stock selection and tracking of the number of stocks in the portfolio. So I am in the market since 2002 and covered many sector, being an analyst in early part of my career. And being at HDFC, we have one of the best research team in the country. We have 11 member, very highly qualified and very experienced analysts, and we cover over 480 stocks in the fund house. So that helps me to continuously have good coverage and also identify the new ideas.
Just wanted to expand on this thing. You mentioned about having a large number of stocks and the help of the analyst in the fund house. So, sir, would you be continue to holding this large number of stocks even going forward, or it will depend upon the market conditions?
Very clearly, I want to reduce the stocks in the portfolio over a period of time, and number of stock has never been a constraint, or I focus on that in my fund management side. What I really believe, stock has a value, and it is a good business, so I would continue to own, actually, rather like I never chase momentum and want to trim or exit the stock. So number of stock is never I consider as a constraint or anything. Because like we are in the market and we cover everything. So what is important is that to give good experience and good return to the investor over a period of time.
Given this whole scenario, what circumstances lead to a selling of a stock from the portfolio?
Generally, I sell the stock from the portfolio in a scenario when I see growth is slowing down, or valuations have reached to the extreme bullishness over their historical average or even to their global peer. And and uh, you know and also I see some macro change in environment which is going to be slightly detrimental to their future growth. So in such scenario, I really get out of the stock. And add to this, I would also say, in certain cases, I run a blend of large cap, multi cap, and large and mid cap fund, where we have to manage the weight of the small cap, mid cap, and large cap in the portfolio. So whenever I see a very high concentration of a category, right, so I have to reduce some exposure in that, actually, so to maintain the risk in the portfolio.
Talking about HDFC Large and Midcap Fund, it has continued to do well. So, can you share with us what is working for the fund? Any specific sector or style calls that have helped? What is it?
Very clearly, the large and mid cap fund has really helped by initially, these pick in the industrial sector a lot, actually, because after COVID, what I found that there was a lot of value in that that segment of the market, and immediately I took a large exposure towards the industrial and automobile in that fund, and which has really helped the fund in initial part. And then what has happened, I moved some of this money to this consumer centric businesses which were really beaten down. So in second part, that has also worked very well. So I take some macro call that how the things are going to behave in the times to come. So and sectoral rotation amongst that line has really helped the fund to generate consistent return. I would only say that in my journey of 5 years, I my call on microfinance institution has not gone right actually, and that led to some moderation in fund performance in the between September 2024 to March 2025. So that is the one regret I have. Otherwise, I have tried to justify and the investors' money in my fund.
Sir, as you rightly mentioned about the having exposure to the NBFCs, which has not worked well for fund, and which reflects in the HDFC multicap in the past 1 year or so. So what are the course correction which you have taken to improve the fund going forward?
So very clearly, like I am very much focused on maintaining and improving the performance. So the what has happened? Few things like when the market had corrected decently by the end of March, or the early April, I moved a lot of money to consumer centric businesses, especially consumer discretionary in the portfolio, and also added some mid cap and small cap IT stock and pharma stock and cement. And and we can see a very decent rally into the cement name, mid and small cap IT and pharma, and especially CDMO opportunity, and weight loss drug opportunity which is there. So that all helped the performance to improve significantly. So, Chirag, I would also like to say that some of the action taken by RBI on the policy side, apart from liquidity and rate reduction, that has also improved the outlook for this NBFC, right, and MFI. So that is also helping the fund to revive. If you see, there is a decent revival in fund performance from April till date.
Right, moving on to the Balanced Advantage Fund, which has a long legacy, including 24 years of under Prashant Jain. So, how did you balance maintaining continuity with bringing in your own strategy?
So first of all, like it is indeed and very is an honor for me as a fund manager to manage the fund, which was earlier managed by the legendary fund manager Mr. Prashant Jain, and very frankly, this is very tough for a guy, a small guy like me, to feel his shoe, right? So like I'm just trying my best because the standard set by him at a very high level actually, right? So I'm just trying my level best, and like I am, as I told you, I'm also a votary of big free cash flow to yield and replacement cost. So what has happened? It gives me a value bias also in my portfolio. So that the legacy which was there in this fund, we are trying to continue with this. And though I have some growth bias also, but so the combination of value and growth, is leading this fund from him till date and going forward. So, and if you see in the last almost 3 years, is has completed since he left our fund house, and I am managing the fund. So in this period, I have given almost 75.9% return to the investor against the benchmark return of 39.65%. So we have beaten the benchmark by 36.2% during this period. So this is a very satisfactory journey so far. But honestly, if I am very small, too small to compare with a legendary fund manager like Mr. Prashant Jain, but I will try my level best to do justice with the fund.
Is there any change in the strategy wise?
Yes. So there is a big change in strategy, and that decision has been taken by the management actually. So after the departure of Mr. Prashant Jain, the management decided to run this fund based on asset allocation model. So we have appointed a separate dedicated asset allocation fund manager, Mr. Srinivas Ramurthy, and he does asset allocation based on earnings yield, bond yield, and trailing P method. So, and he gives me one equity value, and that I have to manage. And as a fund manager, I have plus minus 5% leeway over his equity allocation, right? During after the departure of Mr. Prashant Jain, so we moved our equity allocation from 78% to 49% by September 2024, when market was very expensive. And then in March 2025, and we came back to around 58% equity. So I added significant equity in March and early part of April. So we are really running it dynamically, as so there is a clear departure of a strategy of managing this fund from the historical past.
Okay, okay. Sir, you just mentioned something on the asset allocation, but could you elaborate what is the framework or the model do you use to decide the dynamic asset allocation between equity and debt in this fund?
What our team led by Mr. Srinivas has identified that in Indian equity market, earnings yield bond yield method, the earnings yield bond yield gap really matters a lot, right? So our model is primarily based on earnings yield bond yield gap and trailing P method, so which we give over 90% weight to our asset allocation. And then he has some 10 macroeconomic parameter which overlay this equity allocation, like current account deficit, inflation, fiscal deficit, and other. So, but primarily it is on the two parameter which I explained to you, and based on that, our equity allocation is getting dynamic. And every month, at the start of the month, I get the weight, and I try to adjust during the month actually. So with a plus minus 5% leeway to a fund manager. So we are following religiously to this as much as possible, and that is how we brought down the equity, and we have raised immediately in March, April, when valuation turns favorable.
Sir, if you look at the performance of the fund, it has a long history of a strong performance, but in the past 1 year, it has somehow underperformed. But if you look at the 2025, it has performed very well. It has outperformed. So what are the factors which have led to this outperform in this short period of time?
See, my fund performance is uh, uh, consistently outperforming the benchmark, and this is primarily led by this in the initial phase of the fund, we took the benefit of a rally in the industrial, defense, and power sector. And then what happened, I took the money off from this sector, and moved this money to more consumer centric businesses, pharmaceutical, and some of the IT stock which were really undervalued at that point of time. So primarily we moved money to consumer discretionary and consumption oriented sector, and large private banks and insurance, which were which had a much lower weight at that point of time. So the moving money to private banks, insurance, and consumer discretionary has helped even to navigate performance. So I would like to give a number to you. Like in FY24, the fund has generated the alpha of over 20.71%. Like it is very high alpha of 20.71%. And after that also in FY25, when the rally changed, our fund has still generated alpha of closer to a percent. So generally what happened when you have alpha of 21% in a year, and then generally you tends to underperform next year. But the way we have changed the portfolio has helped to even generate alpha next year, and even YTD this year we have alpha. So the dynamically moving asset allocation and also sector selection has helped to generate consistent alpha for the investors.
Okay, and what do you see as the biggest market risk today, and how is the HDFC Balanced Advantage Fund positioned to tackle it?
See, apart from many risk, in my view, the real risk is earning growth actually, because last year we had only a net profit growth of 4.5% for the Nifty 50 companies, and EPS growth of closer to 2 to 3% actually. So, if in this backdrop, if the market is trading at 25,500 level, right, and we are trading at closer to 21p multiple on the forward side. So, and if the forward earning is under question mark, right? So, if the forward earning has to come, that is the most important thing. So, for me, the most important risk is the earning, and that is the biggest opportunity, because in India, the macroeconomic parameter has turned very favorable. I would like to elaborate. In our lifetime, we have never seen like 10-year GSEC trading at 6.3 or below, apart from COVID or global financial crisis. So now with the RBI is has anchored the inflationary expectation, and global commodity prices are benign. So what has happened? We are seeing, these bond 10-year GSEC at this level, and closer to 6% level. So in this scenario, what happened? Your valuation of the market goes up. Right, so the market valuation is justified. Only risk is earning. If the earning comes, so then we may have re-rating in Indian equity market, because FIIs have sold the market, right? So, and the biggest concern to institutional investor is the earnings actually, right? Apart, like we cannot blame any other parameter in India now. Inflation, current account, fiscal deficit, all are under control. So the real issue is earning. If earning comes, even the global investor would like to see Indian market very favorably. And some moderate risk is that too much of paper supply, right? Because we are seeing, this private equity, uh, even promoters are reducing their exposure. So too much of paper supply is also, like, this is very temporary, but this is also one short risk in the market.
Right. But with so many balanced advantage funds in the markets right now, what do you think sets HDFC's BAF apart for long term investors?
I would really give credit to HDFC and Mr. Prashant Jain to have managed this fund over years and created a brand for and space for balance advantage category in this industry. So, and that is why, yeah, I'm happy that more and more fund houses are coming up with this product, and I really believe this is a wonderful product for savers and retirees to park money into equity market with a tax benefit, and also a moderate risk actually. So right, so in this scenario, I'm happy that many products are coming and market is getting broader, right? So in this, like, HDFC Balance Advantage Fund has stood over time with lot of cycles in last 24-25 years, and yeah, I can only say, like, with our dynamic asset allocation approach, our strong research team, and and very active active call on the stock has helped to create consistent outperformance and good wealth creation for the investor. Apart from this, the regular booking of profit, as I told you, I reduced exposure in September 2024. So we have a decent pool for our dividend for our investors also. So this fund really serves to a lot of investors who are looking to park money after their retirement and get consistent dividend and also capital appreciation over a period of time. So I believe that HDFC Balanced Advantage Fund ticks all the boxes which is required for a moderate risk investor in equity market.
So, Gopal, balance advantage funds by design shift allocation dynamically between equity and debt, which may not always be intuitive to the end investors. So, how should investors think about BAFs in their portfolio? What is it ideal for, and what kind of outcome should they expect from this category?
See, as per the design of the portfolio itself, it is like a moderate risk, right? And so your return expectation should be moderate also from this product, right? Because you run a blend of equity, arbitrage, and fixed income in general in this portfolio. So this fund, is designed to give you moderate return based on the design of the portfolio, basically. Right. So this fund, in my view, is for moderate risk taker and especially retirees and and pensioner who want to take medium risk in the market. I would really say, right. So because like as per this, if you look at the benchmark of this fund, it is like a Nifty 50% is Nifty 50 and 50% is high, is a CRISIL bond index, right? So what it gives you a stability of the bond, and also like you have some moderate allocation toward the equities, right? So that is how your risk also reduces, and that is how your return expectation should be there. And but the fund manager really tries to create alpha over time, and that is how you have seen in a HDFC Balanced Advantage Fund, right? So that helps the investor to create wealth actually. So my sense is that Chirag, the best part of this fund is that you have every time some more cash to deploy. So when you get, let's say you have parked money into arbitrage, right? Because to make it equity compliant 65%. So once the market is down, you can take money from arbitrage and put money into net long equity. So what happened, that flexibility you get in this fund, it is not easy to get in many other products. So the advantage of this product is not well communicated to the investors, right? As a fund manager, I have a lot of liberty to put my money from equity to arbitrage, or arbitrage to net long equity. So that gives a lot of firepower to the fund manager whenever the situation moves either on positive or negative sides.
While a lot of your funds, they hold a large number of stocks, the portfolios, they are still quite top heavy. For instance, in the multi-cap fund and the large and mid-cap funds also, over 50% of the portfolio is concentrated in the top 50 holdings, while the remaining stocks, they form a long tail. So two things I wanted to know there. What is the thinking behind this kind of structure? High stock count, but a fairly concentrated core. And is it a risk control measure, a return enhancement strategy, or a mix of both?
So, Ruchira, very clearly, I want to give the experience to the investor that generally mid and small cap tends to become very volatile, right? And also what happened, the uh, liquidity into mid and small is generally much lower, especially in small cap. And when a business cycle turns or some external event changes, so the fund generally is stuck with a small cap stock for very long period of time, right? It is not easy to exit with the size and scale of the fund. So what I have thought in a way that running the fund with large number of stock and 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 lower weightages will reduce this risk actually to the large extent. And add to this, what happened, I want to create absolute positive return. That is my thought process, though I am not mandated to do that, but this is how I feel that investors I should give a lower downside to the investor and give consistent good performance. So that is why I chose to have more number of stocks in the portfolio. That is unique to me, but I believe this style uh, can generate consistent performance, especially in mid and small cap category, which generally tends to be more volatile actually. So that is why the top stocks I have more concentrated position, and while in mid and small cap I have more diversified positioning in the fund actually.
Sir, given that the multi-cap and the large cap fund allows for the small cap exposures, is there a defined market cap that helps you to filter the lower quality stocks or the illiquid names?
So in the small cap stock, what I have learned over time, that once a company crosses 100 crores of operating profit, then what happens? Their probability of sustaining and growing becomes much higher. So I try to buy companies which have a reasonable operating profit rather than market cap. So once the company crosses 200 crores operating profit, then we really see a J curve kind of wealth creation in the company. Okay, so rather than focusing on market cap, I focus more on operating profit. So that is how I filter the company. Okay, and as you know that the fund size is continuously growing of multi-cap, right? So definitely I try to avoid many illiquid names, but generally I go by operating profit rather than market cap in my stock selection in the portfolio.
And sir, what's your framework for ensuring that a small cap addition justifies its place in such a broad portfolio?
See, when you buy a small cap company, the very important thing is that like my risk reward should be quite high, because generally small cap have more liquidity, and you cannot exit it so easily. So like it should have a sustainable business model. That is very important, and there should be earning growth in the business, right? And I really believe that working capital cycle should be controlled. So what I really look at, working capital very important, then business growth, and also sustainability of the business, and large addressable market. Because when you buy a small cap company with a lower addressable market, then what happened, your growth is limited, so you have to exit at one point of time, if, for sure, otherwise the wealth creation is limited. So I really try to buy the company with a high addressable market, so that I can buy and hold it for very long period of time.
All right. So now one last question. Having managed the fund through different market phases and mandates, what's the one big investing lesson you think long-term investors should remember?
What I have learned, that market environment is very dynamic, and you should not be fixated by an idea that this is the only way of managing money. Okay, what I have learned, people say, I will not buy X, I will not buy Y, or I will buy only X, or I will buy only Y. My mantra of managing money is that I am always open to all ideas. Okay, and because we are in a dynamic world, and the situation changes, right? So what is more important is that to focus on businesses, their intrinsic value, and their potential, rather than going by the past, and going by the past of the business or the management, and you fix your thought that this is good or this is bad. This should be avoided, and we should always be focusing on the businesses and the environment and the management. That is the key to success in this business, especially in mutual fund management business, which is very dynamic, scalable, and ever growing actually.
Right. Well, with that, it's time to wrap up this conversation. Thank you so much for joining in and sharing your insights with us.
Sure. Thank you.
Thank you.